Derivative analysis and valuation. What is the importance of underlying in derivatives? All derivative instruments are dependent on an underlying to have value. The change in value in a forward contract is broadly equal to the change in value in the underlying. In the absence of valuable underlying asset, the derivative instrument will have no value. On maturity, the position of profit or loss is determined by the price of underlying instruments. If the price of the underlying is higher than the contract price, the buyer makes a profit. If the price is lower, the buyer suffers a loss. Who are the main users of derivatives? Derivative markets. First one, corporation to hedge currency risk and inventory risk. Next, individual investors for speculation, hedging, and enhancement. Yield enhancement. Next, institutional investors for hedging, asset allocation, yield enhancement, and to avail arbitrage opportunities. Next, dealers for hedging, position taking, exploiting inefficiencies, and earning dealer spreads. Dealer spreads. Earning dealer spreads. What is the distinction between cash market and derivatives market? Cash market. In cash market, tangible assets are traded. In derivative market, contracts based on tangible and intangible assets like index or rates are traded. Next, in cash market, even one share can be purchased. In derivative market, that is future and options, minimum lots are fixed. Cash market is more risky, whereas derivative market is less risky. Purpose. Cash assets may be meant for consumption or investment. Derivative contracts are for hedging, arbitrage, or speculation. Amount required. Buying securities in cash market involves putting up all the money upfront. Buying futures simply involves putting up the margin money. Ownership. The holder becomes part owner of the company, while in futures it does not happen. What are the problems of forward markets? Forward markets worldwide are afflicted by several problems: lack of centralization of trading, illiquidity, and counterparty risk. Explain initial margin and maintenance margin. Participants in a future contract are required to bring initial margins in order to open and maintain a futures position, just like we pay rent deposit before we step into the rented house. Futures margin requirements are set by the exchanges, calculated under SPAN system, SPAN system, used by major exchanges all over the world. SPAN means Standard Portfolio Analysis of Risk system. Next, initial margins are financial guarantees required of both buyers and sellers of future contracts to ensure that they fulfill their future contract obligations. Maintenance margin. Maintenance margin is the minimum amount a future trader is required to maintain in his margin account in order to hold a futures position. The maintenance margin level is usually slightly below the initial margin. If the balance in the futures trader's margin account falls below the maintenance margin level, he or she will receive a margin call to top up his margin account so as to meet the initial margin requirement. Explain mark to market. MTM. Mark to market is a method of valuing positions and determining profit and loss. Simply, in India, SEBI has specified that buyer and sellers of the futures contract has to deposit the initial margin with the broker at the time of entering into the contract. From there onwards till the expiry date, the future contracts will be marked to market on a daily basis. The process of marking to market. Futures are market to market every day, so the current price is compared to the previous day's price, while the margin accounts of each party gets adjusted at the end of each day. On the same time, the old future contract gets replaced with the new one at new price. Thus, each future contract is rolled over to the next day at new price. Imagine a water tank. We start motor pump and fill the tank daily. This is initial margin. Once the water level goes on decreasing due to loss on futures position exchange will deduct the loss you suffered from your margin account and your margin account will go down. We start the motor pump again to refuel the tank to its initial level. That is margin call from the broker to deposit the money again up to the initial level. Difference between forward contract and future contracts. Forward contracts. Forward contracts are traded in over-the-counter market, whereas future contracts are traded on stock exchange. Default risk. As forward contracts are traded privately, hence bears the risk of default, as future contracts are traded on stock exchange, which provides the protection and there will be no default risk in case of future contracts. In case of forward contracts, there will be no margin. In case of future contracts, initial margin is required to be paid as good faith of money. Forward contracts are used for hedging purpose, whereas future contracts are used for both hedging and speculation purpose. Transparency. Forward contracts are not transparent as the contract is private in nature, whereas in future contract, transparency is maintained and is reported by the stock exchange. Next, delivery. Forward contract is settled by physical delivery, whereas future contract is settled by net cash payment only and very few by actual delivery. Forward contracts, there is no standardized size in forward contracts, whereas in case of future contracts, standard in terms of quantity or amount as the case may be is maintained. In case of forward contract, any valid business date agreed to by the two parties will be the settlement date. In case of a future contract, there will be a standard date, usually one delivery date, such as the second Tuesday of every month. In case of forward contract, all currencies are traded. In case of future contracts, major currencies are traded. In case of forward contract, there will be no cash flows until maturity date. In case of future contract, initial margin plus ongoing variation margin because of mark to market and final payment on maturity date will be there. What are the benefits of trading in index futures compared to any other security? An investor can trade the entire stock market by buying index futures instead of buying individual securities with the efficiency of a mutual fund. The advantages of trading in index futures are the contracts are highly liquid. Index futures provides higher leverage than any other stocks. It requires low initial capital requirement. It has lower risk than buying and holding stocks. It is just as easy to trade the short side as the long side. Only have to study one index instead of hundreds of stocks in case of index futures. What is the difference between future and options, future contract and option contracts? First one, futures, right. In futures contract, both the parties have the right. In case of option contract, only buyer of the option has the right. Risk. In case of future contract, risk is there for both the parties. In case of option contract, risk is there only for the seller. Obligation. In case of future contract, both the parties have the obligation. In case of option contract, only the seller has the obligation. Premium. In case of future contract, none of the parties is required to pay premium. In case of option contract, buyer of the option is required to pay premium upfront. Settlement. In case of future contract, here settlement is must, it never expires. In case of option contract, it can simply expire without being exercised. Next, future contract is not a pure hedging tool, whereas options contract is a pure hedging tool. Next, margin. In case of future contract, both the parties are required to deposit margin. In case of option contract, only the seller of the option is required to deposit margin. Next, write a short notes on in the money, at the money, and out of the money. In case of options, in case the options are exercisable, it will be considered as in the money. If the options are not exercisable, it will be considered as out of the money. If options exercise price is exactly equals to market price, it is considered as at the money. Options are of two types: call money, put money. Call option, put option. Options are of two types: call option, put option. Intrinsic value and time value of option. Premium equals to intrinsic value plus time value. Intrinsic value can never be negative, premium can never be negative, whereas time value can be negative. Premium and intrinsic value can never be negative. Premium equals to intrinsic value plus time value. Define contango and backwardation are inverted market. Basis equals to spot price minus future price. If basis is negative, it is an contango market. If basis is positive, it is an backwardation market or inverted market. Basis will approach zero towards the expiry of the contract. That is, the spot and future prices converge as the date of expiry of the contract approaches. The process of the basis approaching zero is called as convergence. The relationship between future prices and cash prices is determined by the cost of carry. However, there might be factors other than cost of carry, especially in stock futures, in which there may be various other returns like dividends in addition to carrying cost, which may influence the relationship. The cost of carry model in futures is as under: future price equals to spot price plus carrying cost minus returns, that is dividend. What are the assumptions of Black-Scholes model? Options considered are European options, means the options which are redeemed only on expiry dates. The underlying security does not pay a dividend. There is no arbitrage opportunity. It is possible to borrow and lend cash at known risk-free interest rate. It is possible to buy and sell even the fraction of shares. The above transaction does not incur any fees or cost, that is no transaction cost. Stock price movement follows random walk. Stock returns are normally distributed over the period of time. The variance of the return is constant over the life of the option. Factors affecting option valuation. Factors affecting option valuation. First one, stock price. Stock price is directly proportional to call and inversely proportional to put. Next, exercise price. Exercise price is inversely proportional to call and directly proportional to put. Next, time to expiration. Time to expiration is directly proportional to call and directly proportional to put. Volatility. Volatility is directly proportional to call and directly proportional to put. Interest rate. Interest rate is directly proportional to call and inversely proportional to put. Therefore, to summarize, stock price, time, volatility, interest rate is directly proportional to call, and strike price is inversely proportional to call. Strike price, time, volatility is directly proportional to put, and stock price and interest rate are inversely proportional to put. Stock price and interest rates are inversely proportional to put. Option Greeks. Option Greeks. There are 5 option Greeks, 5 Greeks. First one, delta, gamma, rho, theta, vega. Delta. Delta represents the change in option value with 1 rupee change in stock price. Delta equals to change in V0 divided by change in S0. Gamma. Gamma represents the change in options delta with 1 rupee change in the stock price. Gamma equals to change in delta divided by change in SO, stock price. Rho. Rho represents changes in option value with 1% change in interest rates. Rho equals to change in V0 divided by change in R. Next, theta. Theta represents the changes in the options value with 1 day change in the time to expiry. Theta equals to change in V0 divided by change in T. Next, vega. Vega represents the change in options value with 1% change in the volatility of the stock. Vega equals to change in V0 divided by change in sigma. Delta, change in V0 divided by change in S0. Gamma, change in delta divided by change in S0. Rho, change in V0 divided by change in R. Theta, change in V0 divided by change in T. Vega, change in V0 divided by change in sigma, where V0 equals to value of option, S0 spot price of the stock, R rate of interest, T time to expiration. Write a short notes on commodity derivatives. Trading in commodity derivatives first started to protect farmers from the risk of the value of their crop going below the cost price of their produce. Derivative contracts were offered on various agricultural products like cotton, rice, coffee, wheat, pepper, etc. The first organized exchange, the Chicago Board of Trade (CBOT), with standardized contracts on various commodities, was established in 1848. In 1874, the Chicago Produce Exchange, which is now known as Chicago Mercantile Exchange (CME), was formed. Like a stock market, NSE provide a platform to trade in different shares. For commodities, MCX and NCDEX are the exchanges in which trading on commodity derivatives contracts held. MCX, Multi-Commodity Exchange, mainly known for the trading of bullion metals, that is gold, silver, and other platinum and also platinum base metals, zinc, aluminum, lead, nickel, copper, energy, crude oil, and natural gas. And NCDEX, National Commodity Derivative Exchange, mainly known for trading in derivative contracts of agricultural produce like ref soya oil, armseed, gorseed, chana, dhania. All these commodities are traded on its future contract that has a specific expiry date of that contract, and each individual can buy or sell a specific quantity of an individual commodity. Different commodities have different lot size like gold 100, silver 30, zinc, aluminum and lead has lot size of 5000 and copper 1000, nickel 250, crude oil 100 and natural gas 1250. What is commodity swap? In commodity swaps, the cash flows to be exchanged are linked to commodity prices. Commodities are physical assets such as metals, energy, and agriculture. For example, in a commodity swap, a party may agree to exchange cash flows linked to prices of oils for a fixed cash flows. Commodity swaps are used for hedging against fluctuations in commodity prices or fluctuations in spreads between final product and raw material prices. For example, cracking spread, which indicates the spread between crude prices and refined product prices, significantly affect the margins of all refineries. A company that uses commodities as input may find its profits becoming very volatile if the commodity prices become volatile. This is particularly so when the output prices may not change as frequently as the commodity prices change. In such cases, the company would enter into a swap whereby it receives payment linked to commodity prices and pays a fixed rate in exchange. What are the types of commodity swaps? There are two types of commodity swaps: fixed floating and commodity for interest. Fixed floating swaps are just like fixed floating swaps in the interest rate swap market, but they involve commodity based indices. Commodity for interest swaps are similar to equity swaps in that a total return on the commodity in question is exchanged for some money market rate plus or minus a spread. I read a short notes on embedded derivatives. An embedded derivative is a derivative instrument that is embedded in another contract, that is the host contract. An embedded derivative is part of a financial instrument that also includes a non-derivative host contract. The embedded derivative requires that some portion of the contract's cash flows be modified in relation to changes in a variable such as an interest rate, commodity price, credit rating, or foreign exchange rate. Example, let's say there is an entity XYZ which issues bonds in the market. However, the payment of coupon and principal component of the bond is indexed with the price of the gold. In such a scenario, the payment of the coupon will increase or decrease in direct correlation with the price of the gold in the market. In this example, the bond issued by XYZ. In this example, the bond issued by XYZ is the debt instrument, that is non-derivative, while the payments are linked with the another instrument, which in this case is gold, that is derivative component. This derivative component is known as embedded derivative. The non-derivative component here is also referred to as an host contract, and the combined contract is hybrid in nature. Explain the significance of LIBOR in international financial transactions. LIBOR stands for London Interbank Offer Rate. Other features of LIBOR are as follows. It is the base rate of exchange with respect to which most international financial transactions are priced. It is used as the base rate for a large number of financial products such as options and swaps. Banks also use the LIBOR as the base rate when setting the interest rate on loans, savings, and mortgages. It is monitored by a large number of professionals and private individuals worldwide.